So let's start on the presentation. So one of the slides which doesn't change very often and which we've constantly kept it in our deck is basically how to look at equities from a asset allocation and long-term perspective. Uh, our general finding has been that the best way to look at this is to look at what has been the real return of the market over long term. What we mean by real return is the return above inflation. Um, so if we look at 10-year data, the real return, which is basically how much has Nifty delivered on a 10-year compounded basis above inflation is 8%. On 20-year basis, it is 4%. Now, what is the right level for this? The average level for this, not only in India but across markets, is about 6.5%. Uh, it is quite strange, but it is true that across markets, long-term return of equities tends to converge to about 6.5% above inflation. Uh, this is basically because ultimately equity is one way to raise capital for companies. So if the returns are much more than this, then promoters will sell equity. If the returns are less than this, promoters will not sell equities and raise debt or whatever other means, which is why uh, practically the return from equities tends to converge to this 6.5% number. So even long-term data has some base effect. So 20-year data starts from 2006, which was a high base. 10-year data starts from 2016, which was relatively low base. So average is, let's say, 6%, which is where it should be. So net net, the summary of this slide is that if you are looking at very long-term returns, or if you are looking at how to do asset allocation from a very long-term perspective, there is no reason to be super greedy or super fearful. Whatever is your base allocation to equities, it should be according to that. Having said that, generally we have been saying for last few years that overall global and domestic liquidity is quite healthy. So even if the model seems to indicate fair value in the long term, it is okay to be a slightly more aggressive than average. But obviously, we can't be very, very aggressive because the model is indicating that market is fair value. Um, but I'll come to that why we think liquidity is quite healthy. Now, since the market is around fair value, the question is what sectors will drive the market, and this is a debate where we can't have very fixed views. Obviously, world is changing very rapidly. But one point we want to put across is that mostly the sector performance will be led by two big mega themes. One is artificial intelligence, and two is how the geopolitical friction between China and US shapes up. Um, so obviously these themes are new. So if you see the current large cap index, that does not price in or factor in that these themes are there, which is why the large cap index has a lot of IT services, consumption, retail lending, etc. Now, let's assume that both these themes play out in a very intense manner. That a artificial intelligence disrupts India's services exports, which is basically IT services. Part of it, other bigger part is the global captive centers, which over time have become very significant. And let's, on the other axis, if China continues to do well versus expectations and the yuan keeps rising against dollar, which has been happening for last 1 year, let's say, then that combination will mean that some of the sectors which are relatively low in the current market cap index, whether it's Nifty 100 or Nifty 500, see these sectors like manufacturing, commodities, global capex plays, utilities, they they will obviously do much better than what has been the past, because if AI disrupts our services exports, then the rupee will be a bit weak, which will help manufacturing. If yuan is strong versus dollar, that will also help manufacturing. And this will be true for most emerging countries, which means commodities will do well, global capex will do well. And utilities have become some sort of proxies. The power utilities have become some sort of proxy to artificial intelligence also. So the thing is, if we are looking at medium to long term, the call on these two mega themes is important. Having said that, I think we will never be in a situation to be 100% sure how these two themes will play out. And because data will keep changing, and we will have to calibrate our portfolios, uh, but a lot of our effort is centered around understanding the implications of these two mega themes and tailoring our portfolio so that our portfolio reflects how these themes are playing out. Just to briefly touch on these themes, one is China versus US. I think fairly well known. Each has their advantages. The US is obviously very strong in chips, aviation, software. China has a stronghold on manufacturing, rare minerals. In EV, they dominate. Um, and on the financial side, the Chinese balance sheet is probably better in the sense that their current account surplus, their forex reserves, whereas US has a big issue with the government debt. On AI, how it will disrupt services jobs, again, there are many experts with very different views. Uh, Mostly the Silicon Valley people believe that a lot of jobs will get disrupted by AI. A lot of the IT services veterans believe that the IT services companies or the global capital centers will adapt AI, and there'll also be need to implement AI, which itself may drive demand for services. As I said, it's very difficult to take a very strong view on how it will play out. But in general, we feel that both these themes will play out in the sense that AI will have an impact on services exports, and it's quite likely that China may um, emerge as a significant power. Obviously, US will remain the most powerful country, but the yuan is basically a fairly undervalued currency. It has the highest current account surplus. It has very low inflation. Um, the balance sheet is very strong. So we think that the yuan will gradually keep appreciating against the US dollar. So this is more the medium to long term kind of issues. Coming to more near term issue, look, when the war started, a lot of people, including us, of course, we were very worried about both the global economy and the domestic economy. Uh, because such a big energy price shock usually derails the global economy as per historical examples in 1973 and 1979. Um, but thankfully, this time, the global economy has weathered the storm quite well. Um, if you see this chart of employment, the US and emerging markets outside China, uh, they have done very well. Europe and China have been disappointing in terms of growth. That was true before war, and that has continued during this energy crisis. Now, a lot of this resilience in global economy is linked to the capex driven by AI. So there is massive data center capex which is happening, which is why the winners from a stock perspective have generally been the semiconductor companies, uh, predominantly in US, but also in Korea, Taiwan, and to a certain extent, China. Now, if you see how these stocks have done, it has been an outrageous outperformance almost. It has been out of the park. So a lot of these stocks 1 year back were uh, one third or one fourth of where they are today. And these are not small market caps. As this chart shows, we've shown it as multiples of Reliance market cap. So a stock like SK Hynix, for example, has gone from half of Reliance market cap to almost three times of uh, Reliance market cap in just 1 year. So it's been a very concentrated outperformance over last 1 year by these chips and semiconductor names. And clearly, this has been one of the issues for India in the sense that foreigners have persistently been selling Indian stocks because if some foreigner is running a emerging market fund and India used to be 18-20% weight about a year or so back, um, and Korea used to be let's say 8-9%. But the Korean market has obviously gone up almost 100% in 1 year. And therefore, a lot of the foreigners have been forced to sell Indian stocks and buy Korean and Taiwanese stocks, which is which has obviously resulted in outflows from India. So if you see, the rupee has been under a lot of pressure because our um, capital account has been negative for 2 years now almost. Um, there are three big reasons for that. One is foreign investors have been selling equity. Two is Indian households buying of gold and silver shot up, uh, especially during second half of last calendar year. And third is because of Iran war, oil prices went up, and the related items like fertilizer, coal, edible oils, their prices also went up. That all these put a lot of pressure on balance of payment for India. Now, good news is we think that a lot of things have reversed now. One is obviously the Strait of Hormuz has opened to a certain extent, and hopefully a peace deal will be sealed between Iran and US at some point. But anyway, energy prices, but oil is down to 78 from 100 odd. So one is our biggest import item. The price has come down significantly. Two is the RBI has taken some fairly strong steps, particularly the NRI deposit scheme, FCNR scheme. From whatever we talk to bank people, there is a potential to garner 50 to 70 billion in these deposits. Uh, Obviously, a lot of guidelines, fine print, execution of the product. We have to see how it goes. But this is the, if you see the targets of the large banks and total them up, you probably will reach this kind of number, 50 to 70 billion. And that is a very big amount. That can really boost India's forex reserves and stop this negativity around forex reserves dropping significantly. Third is, I think gold imports also are cooling off because some part of the demand was driven by the investor sentiment about prices rising very rapidly. That has obviously started coming off. Uh, Fourthly, some of the commodities, along with oil, have either cooled down or stabilized at least, aluminum, copper, etc. And with that, some emerging markets which are competitors for capital against India, like Brazil, South Africa, they are also cooling off. Because if commodity prices are going down, people don't find markets like Brazil and South Africa very attractive because most of their exports are commodities. Um, the main AI market still remains strong, US, Korea, Taiwan. So we will have to see how they progress. But even if you exclude that, as I said, the above three, four positives, we think that the rupee should stabilize. Maybe it can appreciate 50 paisa to 1 rupee also over next few months. We don't think there'll be very big kind of appreciation, even if things are positive in terms of flows, because RBI has lost a lot of reserves, so they will uh, keep buying dollar to make sure that rupee doesn't appreciate too much. But we do think that the worst for the rupee is behind us. Now coming to liquidity, structurally we think liquidity will be good globally. The simple logic for this is government debt is very high. This again, we've been talking for last 2 3 years that once government debts are very high, there are some options which are tough to do politically, like doing structural reform to increase real GDP or reduce government expenses. Um, since they are tough politically, usually what happens is the easy way out is to keep interest rates low versus inflation. So the real interest rate, as we call it, which is the interest rate above inflation, is usually zero or negative in a lot of these developed countries where government debt is very high. So Japan's been running negative real rate for almost 2 decades now. And that kind of liquidity, because if you're not getting paid anything in real terms for keeping money in the bank or keeping cash, then you will tend to move to risk assets, real estate, gold, equities, etc. Um, so generally, when government debt is high, the monetary policy is loose, and that tends to support risk assets. On the Indian side, the competitors for equities is real estate and gold. Real estate also seems to be losing momentum, at least in terms of prices. It had a good bounce after COVID, but now in many cities the prices are kind of plateauing. And if you take gold, Indians own so much gold that today the value of Indian gold is more than twice of what Indian households have in the bank as deposit. Um, Again, the appreciation over last 2 3 years has been phenomenal. And the purchases, usually Indians were importing $3 to $5 billion per month. In between, when prices shot up, it went up to 7 8 billion for a few months. But now it looks like it has come back to 3 to 5 billion again. And we do think that now with prices cooling off, uh, the incremental allocation to gold and silver will also come down. So, with real estate and gold not offering any great risk reward, we do think domestic liquidity for equities will also be quite healthy. So, if to summarize, our near term view is positive because valuations are attractive. They may not be distressed, but they are definitely quite attractive versus average valuations. And the macro developments in a bunch have looked positive. The Iran war easing off, NRI deposits, gold imports coming off. Also, the fact that, as we were discussing, that the global economy and Indian economy are have been quite resilient. So on earnings, we don't see any big downgrades as long as this war doesn't re-escalate. I think FY 27 Nifty earning growth should be somewhere around 15%. We don't see too much risk to that. Um, in the near term, we think the domestic stocks will likely do well, given that a lot of them had been sold off post that September 2024 high. So a lot of these banks, autos, cement, um, construction companies, etc. We think a lot of them will bounce back because once the rupee stabilizes, and I think the foreign outflow should convert into inflow now. So the focus, I think, will be on the domestic stocks. But if you take a slightly medium to long term view, I think obviously from a long term, the valuations are fair, uh, which means that returns will be similar to nominal GDP of 10 12%. Um, the two mega themes, AI and China US, I think will dictate how sectors perform. I think we have to be nimble, and if AI has a big impact on India's services exports, then we have to shift the portfolio more to exporters and global sectors. Um, as I said, we will never have a 100% answer, but we are obviously monitoring and we will try to be nimble around this. The last point is on the market cap preference. And again, this has been something which we've been broadly consistently saying last 3 years that across this technology and geopolitical um, dimension, there's a lot of change, um, whether it is AI, renewables, defense, a lot of new sectors coming up. We think manufacturing is likely to do well, which is not represented too much in the large cap space. So that's why we've generally been of the view that, see, a lot of people have looked at large cap versus small cap from a valuation perspective, which is important. But the small cap space is a very vast space. Um, Even a mutual fund can look at 600, 700 stocks, if not more. Um, In that context, we have felt that as long as there is change in the economy of a high magnitude, then typically when change is there, the new winners will start from the small cap space. And therefore, uh, we continue to believe that things like AI, renewables, defense, these are very new things that are playing out, and we'll get to see many other new things. Um, so, for example, application of AI itself can change business models across all sectors, and therefore our view remains that from a 4 5 year time frame, the small cap space is the best space to be, because that gives you ability to play either extreme change or sometimes extreme valuation, because sometimes small caps they fall so much in a correction that they go to extreme distressed valuation, which may not be there in the large and mid space. So we continue to maintain that from a 3 5 year perspective, the small cap space is the most interesting space to be.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.